Ladies and gentlemen, gather around and prepare to embark on an unforgettable journey into the exhilarating world of stocks and financial wizardry. Welcome to Stock Marketpedia, where the stock market meets showtime. Let's kickstart this electrifying adventure together and redefine what it means to be the stock market superstar. So without further ado, hit that play button, fasten your seatbelts, and let the financial extravaganza begin. Get ready for a wild ride because Stock Marketpedia is here to rock your world. What are dividend stocks? Before delving into the process of building a dividend portfolio, you might wonder why you should even consider investing in dividend stocks. Well, there are 4 key reasons that make dividend stocks an appealing choice. The first reason lies in the performance of dividend aristocrat stocks. There are stocks of companies that have consistently increased their dividends for many years. Historical data reveals that dividend aristocrats have outperformed the overall stock market. For instance, since 1990, dividend aristocrats achieve an average return of 12.1%, while the broader market had a return of 9.8%. Additionally, they have shown lower volatility and risk, with a 14.2% volatility compared to the market's 17.4%. The second reason is the most crucial and relevant reason to invest in dividend aristocrat stocks is their resilience during market crashes. Considering the 11-year bull market we've experienced, it's important to acknowledge the possibility of a market crash in the future. In such scenarios, dividend aristocrat stocks tend to fare better than most other stocks. The third reason is the concept of passive income. With dividend stocks, you receive regular payments from companies without having to actively work for it. It's like earning money while you sleep, which can be a significant advantage. The fourth is you can benefit from the advantages of passive income, the potential to outperform the overall market, and the relative resilience during market downturns. These reasons make dividend stocks an attractive option for investors seeking stable returns and long-term financial success. Imagine yourself sitting on a beautiful beach on a Miami island, savoring a refreshing cold drink. The best part? You're actually getting paid for this delightful experience. How did this happen? Well, it all began 2 years ago when you made a smart decision to start investing in dividend stocks. Over time, you diligently built up a substantial portfolio consisting of renowned companies such as ExxonMobil, Verizon, J.O. Morgan, Chevron, Disney, McDonald's, Coca-Cola, J&J. These companies reward you with regular dividend payments, which grant you the freedom to live this amazing lifestyle. The primary reason I admire dividend stocks so much is that they provide something called passive income. Essentially, it's income you receive without having to work actively for it. However, it's crucial to understand that successful dividend investing requires some initial effort on your part. First and foremost, you need to make the conscious decision to invest your money instead of indulging in impulsive spending. Secondly, you must carefully select strong and prosperous dividend stocks to invest in. Lastly, it's important to maintain a well-balanced portfolio that encompasses various sectors, yields, and even countries. Diversification. To ensure the success of your portfolio, it's crucial to select good stocks that meet the criteria we discussed earlier. However, achieving a well-balanced portfolio is equally important. Let's explore what a well-balanced portfolio could look like in terms of different sectors. The composition of your portfolio will depend on your interests and understanding of various sectors. For example, if you have a strong grasp of real estate, you might allocate a higher percentage to real estate stocks. Similarly, if you have a good understanding of the technology sector, you might choose to hold more technology stocks. Personally, I favor having a significant allocation to technology stocks due to their potential, but this may vary for each individual. Take Warren Buffett as an example. He prefers financial companies, especially big banks, because of his expertise in the sector. He also holds a substantial amount of consumer staple stocks such as Coca-Cola and See's Candy, as he comprehends these businesses and the consumer side of things. Ultimately, the composition of your portfolio should align with your knowledge and preferences. A key point to remember is the importance of diversifying your risk across sectors. By doing so, if one sector experiences a downturn, you will have a balance in another sector, reducing the impact on your overall portfolio. In addition to sector diversification, it's advisable to diversify across countries as well. While Buffett primarily focuses on the United States, I personally recommend owning stocks from a range of countries. By spreading your investments across different countries, you mitigate the risk associated with any single country's performance. If one country underperforms for a few years, you won't be overly concerned because your risk is spread globally. This approach helps protect your net worth. However, a degree of country diversification may depend on your nationality and knowledge. I suggest following Charlie Munger's strategy of allocating a portion of your portfolio to China, a rapidly growing economy where dividend payouts are likely to increase. Additionally, it's beneficial to diversify into emerging markets. These are countries experiencing significant development, transitioning from poverty to the middle class and providing high returns. Furthermore, Europe serves as a favorable region for diversifying your dividend stocks. It offers opportunities in lesser-known countries, resulting in lower stock prices and higher dividend yields. Always remember that investing carries inherent risks, and market conditions can fluctuate. Staying informed, conducting thorough research, and seeking professional advice are crucial for making well-informed investment decisions based on your financial goals and risk tolerance. Building a dividend portfolio requires a long-term perspective, adaptability, and willingness to adjust your investment strategy as needed. Quality dividend stocks. To help you get started, I want to share some quality dividend stocks that you can consider adding to your portfolio. We've already mentioned Coca-Cola, a stock that Warren Buffett has held for years. It offers a handy dividend with a yield of 2.9%. With a market capitalization of $273.10 billion, Coca-Cola owns a variety of popular brands like Simply Orange, Sprite, Fanta, and Schweppes, provided good diversification from the outset. Another dividend stock to consider is Wells Fargo, also owned by Warren Buffett. It currently offers a nice dividend yield of 3.20% and provides exposure to the financial sector and the U.S. economy. AT&T is another stock worth considering, with a solid dividend yield of 6.52%. This will give you exposure to the telecommunications sector and the emerging industry of 5G. For a more global dividend stock, you may want to look into BP. They operate in Europe, North and South America, Australasia, Asia, and Africa. While they are primarily known as a fuel company, they're also involved in other businesses such as paints, clothes, and packaging. BP offers an attractive dividend yield of 4.48%. When building your dividend portfolio, it's recommended to start with businesses that you understand and have a passion for. Whether it's Coca-Cola in the beverage industry, BP in the fuel sector, AT&T in telecommunications, or Disney in entertainment, begin with what you're familiar with and interested in. Then gradually expand your circle of competence and invest in more complex businesses with higher dividend yields. Another useful strategy is to build the stock picks of experts in the field. In this video, we discuss several stocks owned by Warren Buffett, but you can also explore the investments of other renowned investors like Ray Dalio. Personally, always bear in mind that investing carries inherent risks, and market conditions can fluctuate. It's essential to stay informed, conduct thorough research, and consider consulting with a financial professional to make well-informed investment decisions based on your specific financial goals and risk tolerance. Building a dividend portfolio requires patience, diligence, and a long-term perspective. Where to begin? Once you understand the benefits of investing in dividend stocks, the next step is to determine how to choose good quality dividend stocks. Let's break down the key factors to consider when making these selections. Firstly, it's important to assess the dividend yield of a stock. The dividend yield is calculated by dividing the annual dividend by the stock's price. For example, let's consider Coca-Cola, a stock owned by Warren Buffett with a dividend yield of 2.7%. This means that the annual dividend is 2.7% of the stock's price. As a general rule of thumb, it's advisable to seek dividend stocks with a yield of at least 1% or higher. Another crucial aspect to examine is the payout ratio. Dividends are paid out from a company's earnings. Ideally, you want the business to retain some of its earnings for growth, rather than distributing all of it as dividends. Therefore, a lower payout ratio is generally preferred. The payout ratio can provide insights into whether a company has enough retained earnings for business expansion. To assess the reliability of a stock's dividend, it's helpful to examine its dividend history. Platforms like Macro Trends offer valuable insights into a stock's dividend track record. For instance, looking at Coca-Cola again, you'll notice that they have consistently increased their dividend payout for 56 consecutive years, even during recessions. This track record demonstrates reliability, indicating that even during market downturns, you can expect to receive a steady income from the stock. Additionally, it's essential to evaluate a company's future prospects and its ability to generate earnings. Consider factors such as the company's business model, competitive advantage, and potential for earnings growth. Taking Coca-Cola as an example, their strong global brand presence and customer loyalty contribute to their competitive advantage. These qualities attracted Warren Buffett to invest in the company, recognizing the customer's dedication to the product. When selecting dividend stocks, it's crucial to conduct thorough research and due diligence. Look beyond just a dividend yield and consider the company's financial health, dividend history, payout ratio, and growth prospects. Diversifying your dividend portfolio across different sectors and industries can also help manage risk. Remember, building a dividend portfolio requires patience, a long-term perspective, and the willingness to adapt your investment strategy as needed. That's a wrap for today's video, but the excitement doesn't stop here. Get ready for more mind-blowing content coming your way. We'll be pumping out videos 3 to 5 times per week, so buckle up for an exhilarating ride. Drop your comments below with your topic requests because we want to hear from you. And don't forget to smash that like button, subscribe, and hit that notification bell to stay in the loop. Stay tuned for the next thrilling episode on Stock Marketpedia, where we make stocks sizzle.